and welcome. You're watching Business Today Television. I'm Sakshi Batra and this is What's Hot, a show that focuses on the biggest buzz on the day street. Today on the show, we are going to be focusing on what has really led to a sharp fall in the IT stocks in India. What is this Anthropic's new AI tool that has shaken the global IT firms and has caused an IT stocks meltdown across the world? We will also be focusing, of course, on decoding of the impact of the US-India trade deal and the union budget presented in the last couple of days. We will also be focusing on the newer themes, the strategies that you should be focusing on the markets as well. Let me quickly look at the markets at this point. 25,782, we are barely about 55 points higher in trade. So holding up a tad bit, 2/10% higher. A lot of sectors that are still hoping and supporting the moves are oil and gas, metals from the commodity basket. Infra stocks are higher. Auto stocks also in the fast lane. You can also see financial services, banking names up and about, but it's the IT stocks that have seen a meltdown, over 5% of a crash right now that you can clearly see. Real estate stocks also, after some days of a move on the positive side, are giving up some of those gains at this point in time. Let me now welcome our guest on board, Mr. Mayuresh Joshi, the head of equity research at William O'Neill India, is joining in to share his views on the markets and all of these factors. Warm welcome to you, Mayuresh. Good to have you with us on the program. Let's start off with Anthropic triggers and how this new AI tool plugins, they are aimed at automating tasks across software and legal companies, and therefore we have seen US markets see about a 1.5% fall on the Nasdaq. We've seen across the board also in the Indian markets a sharp sell-off. Large cap companies, mid cap companies, they're all seeing cuts, deep cuts of single high digit fall that we are seeing today. What really is this new fear that has gripped the IT space worldwide?
Morning, Sakshi. Always a pleasure to be on your show. So I think what has really transpired late night yesterday is that Anthropic has probably developed some sort of a new AI automation tool. And the fear on the market or the street is that it could eat into the core business of data and info services firms. So I think data processing firms, which is a large part of the Indian IT ecosystem, might get affected with that. But it is not just IT stocks. You look at what happened with US stocks overnight. Atlassian, ServiceNow, Salesforce, Gartner, Accenture, all of these stocks were significantly lower. But the differentiation factor that one really needs to bring about is that the AI products and platforms that these companies will keep on developing are going to probably create competition across the globe, specifically when it comes to the large IT majors who are in the process of development of products and platforms. Our IT companies are having a very distinct process in terms of data services, processing and outsourcing, which caters to a large part of different industry subsector pool and substacks as we speak. And therefore, I think if you probably look at AI and the 5 layers of AI deployment, I think a large part of the US tools and markets and products that are probably created are created in terms of products and platforms. I think the value addition that our companies probably can do and will do and shall do is the application layer itself. And therefore, you have to distinguish between US product and platform companies and what our companies are doing. Obviously, there's going to be competition, but we'll have to brace for that.
To brace for it. I remember, Mayuresh, speaking to you about the IT sector over the last 1.5 years, and you've largely stayed away from this space. You've cautioned investors largely. You have, despite any of the positive triggers, you were not too keen to aggressively go in and buy the dip. What have been the reasons so far to stay away from the IT? And is this adding on to that reason once again, despite the fact that we have some positive triggers from the US?
No, so I think the premise was pretty simple, Sakshi, that the kind of automation and capital infusion that is happening with a large part of the major IT product companies, that is still going to continue. So they are not going to stop. I think it's just going to be more fierce in the next few quarters as we speak. And therefore, as this entire automation race continues, it is good to rattle the sector as a whole. That's one. Second, I think outside US, I think China is having a huge say when it probably comes to AI product platforms as well. I was just sitting across with somebody over the weekend, and they were saying that China is producing some brilliant stuff when it comes to automation and AI. And therefore, services, which has been an integral part of not just the Indian ecosystem for our IT companies as well, are facing serious competition threats. And therefore, I think our IT company models have to evolve. It's as simple as that. We just can't simply rely on the simple outsourcing, outprocessing model a couple of decades ago, which gained us significant market share and services revenue as well from an export perspective. But I think our IT companies need to start evolving in terms of ensuring that they embrace AI and probably have some element of AI, at least in terms of the application layers that they're about to present.
So, Mayuresh, all those investors who have been building on their positions in this underperformance of IT sector over the last 1.5 years, thinking that good times will return once the US-India trade deal is signed and once things improve on the economic front as well, what should they do now?
No, so I think things are not going to drastically change, Sakshi. Let us be also cognizant of the attack. Like we speak about power, right? That renewables and EV will just take over. It's not going to happen. It's still going to take its time. And therefore, in the IT sector as well, this is going to take time. Obviously, the pace at which agentic AI agents are being used, the layers are being deployed, is pretty fast. And therefore, I think the entire premise that I'm trying to build up is that our companies cannot take it with laxity, that we'll do it after a few quarters. Let us look at some organic acquisitions. Inorganically, we'll start upskilling our employees to a certain extent. And therefore, I think the kind of ecosystem that is now getting created, independent system as you're putting on your screens as we speak, the codes are easily decipherable by coders across the globe. So there is no need in terms of a clouded internal coded system which just gets within a closed environment. I think it's an open environment where people can plug and play and create more tools within the tool that is probably getting created for their own end application uses as well. I think that is where companies need to gear up. And therefore, I think the model might continue over the next 2 to 3 years, no two ways about it. But if you start thinking down the line, I think 5 years, 10 years down the line, you need to start thinking now so that the changes are visible in terms of the business model diversification that our IT companies can present itself 5 years down the line.
Correct. We've also seen a large part of IT earnings come in already. What has been your own reading of the IT earnings in Q3? Has this given us any ray of hope that things are improving for the better, or will patience, need to be had, for some more time to come?
So I think decent numbers, whether it's large cap or mid caps to a large extent. And again, why mid cap IT companies are a tad better off, even if valuations are expensive compared to their own standard deviation and compared to the large caps, is that they typically have this sweet order size between $1 million to $10 million. Now, every company is not going to have an extensive AI or an automation budget. And therefore, I think mid-sized companies across sectors will still have those constrained budgets where they'll have those AI processes coming in slowly and steadily as demand needs. But I think it's not going to be an extensive overall that probably comes in place. For larger companies, orders are still flowing in. You look at the TCS order book, you look at the infra order book, the HCL numbers were stable. But I think the margins at which these orders will now come in will be consistent. You can't expect a margin outperformance coming through from the existing order book or the succeeding order book to come through. And therefore, I think it's very, very predictable for large cap IT companies in terms of the constant currency revenue growth margins. And outperformance is something which is going to be very, very difficult in the environment that we are operating.
Oh, fantastic. Okay. So, still, if I have to choose better from the worst within the IT pack, how would you approach it?
So my belief is that looking at rating rankings, how we see it in markets with India, our expectations in terms of leadership positions within the sector itself. I think a few mid-cap companies, as I said, are probably placed a tad bit better as we speak. Valuations, again, as I said, is not in favor compared to its own valuations or the large caps. But that is where at least the numbers are coming as we speak at this juncture. Large cap, decently placed. I don't think there is a structural downside as we speak for
Okay.
this, well, even with this news. But again, mid cap, tad bit better placed again compared to the large caps.
Okay. Moving on from the IT space, let's talk about about the elephant in the room that everybody is watching right now, and that's the US-India trade deal. What's your sense? First, 18% tariff as of now. There are some statements still coming in, saying that we are not going to be completely halting or stopping the purchase of Russian oil. Can there still be a rethink on this number of 18% tariff? Is this limited to certain sectors, or is it a blanket? And second of all, how would you really see now that the primary deal seems to be done and now only the fine print will come in?
No, so I think the markets have taken it with joy, and what was expected to be a manic Monday post the STT announcement turned out to be a joyous Tuesday. So I think this is certainly good news, and the sentiments have turned for the better, which was needed for Indian markets, which have underperformed last 18 months. Coming specifically to the India-US trade deal, I think unless it is signed in fine print, unless we know the contours of the deal, the markets will now like to see what is finally coming out in the fine print. You never really know with Trump that if he suddenly announces something a week down the line, everything probably goes disarray as well. And therefore, I think the fine print and the contours are extremely important. Looking at 18%, I think we are better off than our peers, whether it's Indonesia, Vietnam, Bangladesh. The export-oriented sectors which had got hammered obviously have a sense of relief as we speak, so whether it's textile makers, shrimps, the jewellery makers who supply predominantly to the US market in terms of value. They're all expected to bounce back, which they have already done over the last few days. When the fine print comes, let us also understand, Sakshi, that ultimately it is still going to take time for numbers to start coming through. Even with the EU FTA, I think it is going to only start in FY27. So now the deal is that sentiments have got played out. But the next 2 quarters, nothing is going to change materially on the balance sheet. I think that is what the street to understand, and they will. And therefore, I think sentimentally, I think the stocks have moved up. Sentimentally, the markets have moved up as well. But then it's back to the grind, earnings.
Okay. And is that the clear reason, like you point out, why, the post-US-India trade deal enthusiasm is struggling to sustain on the D Street? Today, we also dipped for a moment as well, and now we are holding above 25,770 odd at this point in time. Do you think most of the good news is now on the price? And like you pointed out, when the fine print comes in, when things start to actually move on the ground, only then will the markets now price in the future positives.
So as on that, good news priced in, but again, sentiments have changed. Actually, that is extremely critical for the markets. We were down and out after the STT announcement, and therefore I think the sentiments becomes a very integral part of market participation. Sentiments have changed. If this goes in the avatar, that is in fine print, I think what the market is now sensing is that a large part of this overhang when it comes to trade deals, trade tariffs is largely behind us. FY27 numbers when it comes to the export aspect or the macro aspect should be relatively better. At the same time, with all these aspects playing out, the budgetary allocations that have probably happened in terms of capex announcements, a modest target that has been set for nominal GDP revenue collections. If corporate earnings grow at a faster pace, with private capex coming back, the gross capital formation expected to be better, the private final capital consumption and current consumption on a retail side also expected to be better. I think if that turns out to be better, I think from the June quarter, if numbers start coming out in that 12 to 14% consensus range, macros and micros firing will make India the most attractive destination, and the underperformance can quickly turn into outperformance as we speak. So sentiments have changed. People are more buoyant and optimistic in terms of how they're feeling about the markets. And 3, in terms of core data points, if this aspects play out as the street believes, I think India will be in a much better position as we speak at the same time next year on the same date.
Right. If I have to ask you to help me identify certain sectors that you believe will be the front runners and the front benefit sectors, when it comes to the trade deal, which ones would those be? And are you already strategizing your clients' portfolios towards it?
There are going to be momentum calls as we speak because a large move has happened, and obviously beneficiaries are textile and shrimp makers as we speak.
Yeah.
A few capital good companies also, because what you were mentioning was that we're hearing the managements of Bharat Forge, RK Forge. So Section 232 probably, which still implies that 50% tariffs can happen in certain areas and certain sectors, might not apply to these sectors as well. Steel, not really sure at this juncture. In terms of steel, I mean commodity players, not really sure at this juncture on what really goes through. But generally, I think a large part of the move has happened, but the overhang probably goes off for these sectors. So I think momentum-wise, I think a few of these auto hangs, shrimp makers, textile makers can continue.
Okay. So, Mayuresh, what do you make of some of the caveats that Donald Trump mentioned in his post as well? That, $500 billion worth of purchase. Now some, statements are coming in that this has to be looked at from a period of 5 years and not 1 year, because we just import about $45 billion. How do we, escalate to that number? It seems impossible at this point. And how do you look at the conditions that, we have to completely stop Russian oil purchase at this point in time? How would you look at these statements?
So again, I think it's how we tackle it diplomatically, right? And our government has been extremely proactive about this whole process. We did not rush into that, where others were being coerced into probably signing deals. We still took our time. At the same time, silently and steadily, we were doing the EU FTA, which created an additional pressure on President Trump, whether we like it or not. 30% of global GDP is going to get covered in terms of the EU-India FTA. And obviously, I think Trump sensed that with the Australian FTA signed. We've signed FTA with a lot of Middle Eastern countries. I think the momentum was definitely shifting away from the US, and he had to seize the moment. So again, I think that probably the EU FTA probably was a game changer, which forced Trump to probably do what he did.
Okay. All right. So that now the fine print is awaited, and viewers, we will have to focus on that once things come in to really find out whether it's a win-win deal and how do we really diplomatically make it so. But on the budget specifics also, of course, like you pointed out, the STT hit overshadowed everything that was announced probably as a long-term vision in the budget. But your own sense of how should the markets read this budget from medium to long term?
So I think, Sakshi, if you leave aside STT, right, the budget was pretty well balanced. Now you've got a decent capital outlay when it comes to the capital expenditure on an overall basis. Within that, infrastructure has received, again, a decent chunk. Defense has received a decent chunk. Roads, railways, close to 2.7 lakh crores as we speak. And therefore, I think infrastructure development and the capex around that is huge. Private capex coming back as we speak. If you probably look at the economic survey report, logistics as a percentage of GDP from 14% a few years back has come to 8% and is expected to head even lower. So I think you're seeing those incremental changes happening because of infrastructure development in terms of logistics costs going down. And with all these measures taking place, I think the bump up in GDP is expected to be significantly better 2, 3, 4 years down the line. Fiscal path has been maintained. The nominal GDP, in my opinion, has been kept at a very modest 10%. My own sense is that with the US trade deal, if it goes in the avatar that it is the EU FTA that is getting signed, the numbers will come incrementally. But again, I think the boost that the exports will receive and the expectations in terms of a share of 40, 50 bips on our GDP, again, I think that share off probably goes off. And therefore, I think the 7.5% real GDP growth with a 3.5% as a bare minimum in terms of the inflationary number makes us believe that 11% nominal GDP is achievable. Revenue targets have been kept modest. And therefore, it's a modest approach that the government has probably kept with a decent outlay on capital expenditure across different subsegments, which makes me believe that the multiplier effect will continue on India Inc.'s balance sheet. Debt GDP at 55%, but will start down. But again, I think outside STT, I think a lot of positives that the budget will that the budget is.
Yeah, so on STT, what is the impact that you're already penciling in? Will this further deter the foreign investors to come into the Indian markets? At this point in time, we were waiting for some measure to bring back the foreign money into the Indian markets. But this step, do you think, is going to deter that?
Well, I think it will not have a material impact, right, for foreign
Okay.
investors in particular, because I think in terms of value, I think it will not matter too much for them like a retail investor. I think a retail
Hmm.
investor will have a much more impact compared to a foreign investor. I think what the Exchequer wanted to imply through this raise is that the speculation that a lot of retail investors face, the losses that they probably incur on the F&O segment, I think they want to curb that. But there would have been other measures as well. I think there are plenty of measures that you can probably do. Example, increase margins, right, significantly. Once you increase margins significantly, I think that can probably have a lot of say in terms of how retail investors' capital, upfront capital probably goes in terms of carrying out a trade. However, I think the direction of the exchequer is right. I think that speculation needs to get curbed. But the market probably saw that as a deterrent because what we understood was few years back that STT was introduced to phase out
Yeah.
LPG. Therefore, that confusion continues. But one important aspect that the budget threw out, Sakshi, is that the residents outside India, not necessarily Indians, the limit is going up from 10 to 24%. I think nobody is discussing that. There are going to be FEMA changes that come through, and I'm closely monitoring that. I think over the next weeks or few months, the FEMA changes, if they're very, very attractive in terms of
Yeah.
entry and exit, for investors sitting out of India, you've created a new capital pool of investors who can probably look at Indian markets, which is a huge thing that the finance minister has done, and kudos to her on
Okay, fantastic. Let's also now focus on, the post-budget themes. A lot of positives, like you pointed out, we've seen a lot of focus on the sunrise sectors, tax holiday for companies setting up data centers, cloud in India, and a long tax holiday of about 22 years odd or so. Then beyond that, if we look at, the biopharma space, the semiconductor space that was in focus, for somebody who's looking at these thought processes of the government and where the government focus is going to be over the next 5-10 years, how should one be really looking to grab that opportunity within the markets? There are still very few stocks that you can directly bet big on an AI or a data center or a semiconductor, still very few minuscule stocks. So how does one really go about it?
Oh, very, very few. You can count it on your fingers, actually. I don't name them. So I think they've already moved quite significantly. But
Yeah.
from an sectoral allocation perspective, I think capital goods, infra, selectively will continue to do it well. I've always maintained that PAR as a theme and the
Yes.
within PAR will continue doing well because there has been a significant outlay. Again, if you look at chapter 14 of the economic survey on the gross credit front that got deployed last year, significant portion got deployed towards power. And therefore, 500 gigawatts is what we have combined with renewable and thermal. 500 is expected to be renewable itself in 2032. So I think a tad bit of a mix of manufacturers, EPC players, the battery energy solution system. There has been a lot of incentives on that as well. Will continue doing well. Consumer staples as a space, in my opinion, will continue doing well. And to support all this, the banking system plays a very, very integral and key role for any economy. And therefore, I think the banking and financial system will do well. So I'm pretty confident what we are doing from a macro perspective is going to play out beautifully. I think India is the market to be, Sakshi, over the next few years.
Okay.
And the next 2 years, I think we will become, in the next 3 years, I'm definitely sure we'll become the third largest economy.
Okay, so that's the confidence coming in on the Indian economy and the Indian growth story. Let me also ask you, beyond markets into the other asset classes, gold and silver, what did you make of the sharp fall that we witnessed a couple of days ago and the recovery that's underway? So was that a missed opportunity for investors who were thinking and that, we shouldn't have missed the rally, we should have got entered, whenever the chances were? Or do you still think that there could be some more dips that we could see going forward?
No, so I'm not an expert on gold and silver at all. But I think looking at how the volatility is, I think one must really understand that gold and silver are elements of a store of value. They are not elements of stores of investment. So one thing we should be very clear that gold, silver is a store of value. And therefore, I think a 5 to 10% allocation is always what I've maintained. That should be part of your portfolio. It hedges your portfolio to a large extent. And it also creates a kind of a cushion in difficult times. And I still maintain that view that it should form part of your portfolio to the extent of 10%. SIPs is the best way to go about it. And there are various mechanisms in terms of how you can do your SIPs through the exchange related and regulated.
All right. Okay. The time's up, but we could have gone on to discuss this further. Mayuresh, thank you so much for being with us on the show. It's always a pleasure to seek such wonderful insights and the clarity with which you really speak to all our viewers. That really is appreciated. And we do get a lot of comments, asking for you to come back again. So we hope that we continue to have this discussion more often. Thank you so much.
Thanks, Sakshi. I understood that it made sense. So thanks for that.
Thank you so much. All right. Have a good time. We'll see you soon, Mayuresh, in Mumbai or when you come in Delhi. Thank you so much. All right, viewers, we'll wrap it up on that note. 25,743. Mildly up as far as the markets are concerned. Yes, Mayuresh did point out that US-India trade deal sentiment improvement is a big thing that was needed at this point in time. But most of the good news in terms of sentiment is out. And now we will have to see how things really play out in the fine print and on the ground as well. But still a lot of opportunities in the markets. He still believes the markets over the next 2 to 3 years have a good run up, and the world, India is going to become the world's third largest economy, and that is going to be the major trigger for the markets to move forward from here. Thank you so much for being with us on this special.